Welcome to the next video from the series which I've previously completed. I am going to revise the topic of Brexit again. I know that it's been a little bit of a gap since I last talked about it, but that's because it's a complete mess, for want of a better word. Now, the thing that struck me, because the whole thing is personal as well as professional. You have to look at what's going on with the politicians, or rather what's not going on with the politicians, because the political process determines what the investment outcomes are going to be for people's portfolios. And if you do not keep an eye on what all the various probabilities are going to be, then you're not going to be prepared for what the final outcome is going to be. So if you look what we have a combination of project fear, and I'll go into that in a second, project misinformation, and project delay. Now, I remember us saying long ago when I first started out in investment business that a confused mind says no, and I think that the political establishment of both the UK and Europe are doing a very good job of confusing people to what's going on, and this is having disastrous consequences for many small businesses, and therefore long-term viability of those businesses, and it's no wonder that they're worried. Now, just going back onto this project fear, we've been seeing a lot of commentary on behalf of the politicians, etc., saying that things are going to be a mess in Europe regarding visas, and the EU is going to charge visas, and that's something that's possibility, but is it going to affect the economic outcome of these economies? There's much more going on behind the scenes that will do so. These are more tangential problems that could exist, but certainly what's going on behind the scenes is much more serious. Now, let's look at this particular slide that we have here, and this goes back to the project fear and the project misinformation side of things, which I just want to briefly centre on because I think it is relevant and it is relative to what's going on. Let me just read out this here, and this comes from the Telegraph, which is a UK paper on the 2nd of March, and it basically says the Spanish government has issued a range of measures aimed at protecting British citizens in the event of a no-deal Brexit. So basically what it's saying is, what I'm reading into this and what many strategists are reading into this is that no matter what the politicians are saying, ultimately at the end of the day, countries with a national interest are quite prepared to deal with England within the European Union or outside of the European Union. And it goes on to say that Spain will also provide residency for an estimated 400,000 Britons and preserve freedom of movement across its border with Gibraltar. And this is done by royal decree. So scare tactics in terms of no freedom of travel, what's going to happen to British residents in EU countries, what's going to happen, for example, to the residents in Spain, Gibraltar, France and Italy, where there are a lot of UK residents, is probably nothing. The status quo will probably stay as it is because there are a lot of Spanish, Italians, Irish, all nationalities in the UK. Especially in London. I mean, 55%, a recent survey was done, 55% of London residents weren't born in the UK, so it's a moot point. So the aim is to preserve, as again reading out from, the aim is to preserve the interests of citizens, Spaniards in the UK and Britons in Spain, who exercised their right to free movement before Brexit. We have to respect that, Spanish Foreign Minister Josep Borrell said at a news conference after the meeting. So this sort of reinforces what I've said basically about the fact that things aren't going to change much on that. Now, let's get back into more deeper economic woes, why I think and I believe that there are machinations to prevent a clean Brexit. If you've been looking at the news, you can basically see that the German economy in particular has just escaped going into recession. Now we know the Italian economy's gone into recession. We also know that the Greek and the Spanish and the French economies have not done so well either. But the real worry is that that the German economy is rolling over. What we've seen is that it's an economic powerhouse, and as far as the statisticians are concerned, we have seen that we've seen a 0.2%, minus 0.2% growth in German GDP for the last quarter of December, and 0% growth this quarter, and forecast by Trading Economics of 0% growth in the next quarter. So what this means is that we have a problem with Germany. And why is that important? Well, because if Germany goes into recession, the last thing in the world they're not going to want is no trade with the United Kingdom, which is the fifth largest country with GDP in the world. So that's a major market. And you only have to go to London, or the United Kingdom in general, and you'll see how many BMWs, Mercedes, Volkswagens and French cars. It's a massive market. So if you don't do an independent trade deal, you're going to go into recession if you're not already in it. And so the risk in the German economy is this will exacerbate. They won't be able to fudge figures. They're going to go into recession. So going into this particular article as well, this was an interesting Bloomberg article on February the 13th as well. And this goes into all my previous videos where I say Europe is a ticking time bomb as far as the world investment side of things is concerned. And the title is that Europe looks like the real weak link in the global economy. And so the commentators are now saying time after time after time that this is where the problem is. Let me read this to you, and I think this is quite important. For all the palpitations that the trade war between the US and China will knock out their economies, it is Europe that increasingly looks like the biggest threat to global growth. Furthermore, it goes on to say, industrial production across the 19-nation euro area is falling, and this is important, is falling at the fastest pace since the financial crisis. Listen, since the financial crisis. Now, and it goes on to say, deteriorating demand is evident as the region finds itself squeezed between international and domestic pressures. That leaves expansion at risk, barely topping 1% this year, a sharp slowdown from 2018, with even continental powerhouse Germany in trouble. So we have even Bloomberg and commentators saying this. Now, if we look at this particular slide here, we can actually see that when commentators say, oh, there's going to be 1.5% growth, and the EU bureaucrats are saying there's going to be economic growth of 1.5–2%, Germany's going to powerhouse out next year. Just look at this chart here. It shows the difference between real GDP growth and the forecast GDP growth. So when the mainstream media and many of the economic pundits are saying everything's going to be hunky-dory next year, no, the figures don't lie. The charts are there. So what I see is that the EU in particular is running scared. Now Germany's growth, as I said, was -2%, 0% this quarter, 0% next quarter. And, they may not officially be in recession, but you can't tell me 0% growth and 0% growth forecast isn't heading that way. And so this is a major problem that this could creep up on the national psyche. So why is this important for Brexit side of things? Well, here's a very interesting question. Why do people want to remain in a sinking ship? If Germany's going down and Italy wants to get out of the ship into the lifeboats, and Hungary, because of immigration issues, wants to get out, why is there such a strong movement to stay within the Union? Well, I think it boils down to some extent of globalist versus nationalist sentimentalities. Now, when I say nationalist, I don't mean things like National Socialism and all this sort of thing. I'm talking about people who want independent countries and independent economies. Because, for example, the EU banks are in disastrous shape. You just have to look at the recent correspondence, the recent debacle, basically, with Santander Bank in Spain regarding cocoa bonds. These are contingent convertible bonds. Basically what these are alternative tier investments, tier 1 capital. that banks have to sustain their balance sheets with on top of the Tier 1 capital. So this is a requirement. So COCO bonds, the market's about 140, 160 billion worth. And what Santander Bank basically did very, very recently was saying, well, we're not going to pay the call on these bonds. Well, what are these bonds? These bonds, as I said, are a means of financing balance sheets that are a buffer when the Tier 1 capital requirements drop below a certain level. But this is the key. There's several keys in this. First of all, if the trigger is implemented, what happens is these bonds are converted into equity. So the bondholders don't have a choice, basically, of when to buy the shares. They're immediately, when the bank is in trouble, and it's probably it is the least likely you're going to buy the shares, they're converted into equity. But what's worse is that when they're converted, all dividend payments are suspended. So there's no capital repayment on those equity, on those shares. It's a disaster. It's a disastrous investment for the institutions that are doing it. But what it's done, what the Santander thing is, to me, it's highlighted the fragility of European balance sheets, bank balance sheets, because not only have the Tier 1 capital balance sheets got dodgy sovereign bonds, Italian, Greek, etc., like that. Now we have Tier 2 capital that is potentially disastrous in a foretaste of what could happen in any bail-in situation. So you really have to worry about this. So this is another thing, going back to the bonds that I've talked about before, that we're potentially seeing serious problems with European banks. Now, I have a theory as much as anything else, and there is a lot of hard facts to put this out, but the people will disagree with this. If there's a successful Brexit, when the going gets tough, others will follow. Italy's behind the scenes, as I say. There is a movement within Europe for less onerous bureaucracy. So what is the reason, if people are wanting to get out of this lifeboat? I mean, look at Italy. Its banks are on the brink of failure. The government is seriously considering doing the unthinkable to the EU bureaucrats. If they let Brexit occur painlessly, the Italians will put their hands up, say, can't pay, won't pay, I'm leaving. That's it. So this can't happen. And Germany's banks are already overstretched. I mean, we just have to look at the recent news of the potential merger between Deutsche Bank and Commerzbank. Well, that's two bad banks don't make a good bank. That's common sense. But maybe, I don't know what the EU bureaucrats are wanting to do out of this, but it's exacerbating too big to fail into a too big to rescue organisation like some of the US banks potentially. And we're looking at Germany. What Germany with now zero growth and zero interest rate policy, and it cannot bail anybody out anymore. And furthermore, it's going into recession. But you've got zero interest rates, negative interest rates even in Switzerland, and we're going into recession. Stimulus isn't working. We have a major structural problem with debt and its efficacy in stimulating economies. And if anybody's not waking up to this, this is a real problem, and it's not looking good for the future. And I see potentially in the very near, well, not necessarily in the very near future, but when these things start to unravel, bail-ins and banks are going to be, something that's just going to happen straight away. So what does this mean? It means that we have to watch and see as regards to our portfolios, etc. You see, if Brexit occurs, and it occurs with a no deal, that's going to have currency effects. But to me, those currency effects are going to be short-lived. I mean, the sterling is trading in the top 120s at the moment. So 2.5 years ago, before Brexit, it was in the mid-150s. The thing is that after things like this occur, there is a normalisation process. So between this particular stage of uncertainty, which the government is certainly responsible for, and the delay that's potentially postponed, the delay, for example, is just postponing the inevitable, there is a very great reason, in my thoughts and as part of the theory, that the EU, the bureaucrats in the EU want England in the fold, so as we're all in this together. When their banks go down, you have to contribute 100 billion or 150 billion, and because you're in the EU, you can't get away from this. To me, a clean cut, no matter what your political views are, is probably the best thing for investors in the UK. Is certainly not necessarily in the short term, but the medium to long term, as World Trade Organization agreements go ahead, because countries in recession like Germany, France, Italy are going to have to negotiate. So this project fear, project misinformation and project delay, it's a non-issue. The EU is going to go down, and if Brexit doesn't occur, it could really bring the whole British economy with it, and all your investments and all the whole thing. So yeah, this is my position at the moment, and I think the facts that I've presented about Europe bear this out. So I will be doing another video on Europe later on this week, in particular Italy again. So I look forward to seeing you in the next video. Thank you and bye.